Howdy there, folks. Welcome into today's video. Tom Lee. Yes, Tom Lee is the one giving a major warning to stock market investors out there. We're going to listen to what he has to say in this little 2-minute clip here about bracing for an air pocket after recent rally. Okay, so Tom Lee's being a little careful and scared. This should be interesting. Next one up here we'll react to is job openings increased in December. Confidence hits highest since December 2021. That should be interesting. Josh Brown and 6 stocks affecting the market's momentum this year. Looking forward to getting into that. 2-minute clip there. And then this one, global investors are all in the United States, says Goldman's David Kostin. So looking forward to getting into that one. I appreciate y'all joining me as always. Thanks so much. All I need from you, smash the like button. Make sure you subscribe to the channel. We just hit a new all-time high subscribers in the history of this channel. I appreciate each and every one of you. 38,000 plus now at this point in time. Also, right after this video is over, I'm going live on Twitch. If you want to join me on that, it's the pinned comment down there. We have a bunch of big earnings after the bell here today. It is Google, Microsoft, I believe Starbucks is a bunch of big ones, big dogs after the bell here today. So I'll be reacting to those live. Literally pretty much right after this video releases.
Last time, you made an interesting prediction. I want to play that. Here it is.
I think it's possible that we make a minor new high before the end of the month, and then we might have something like a 7% drawdown.
Since then, the Dow and S&P 500 have hit record highs. I mean, I think we're on track now for 5 days of new records. Are you...
You don't get often where Tom Lee looks too bearish. This is interesting.
Still predicting a pullback, and what would be the catalyst there?
Well, as that clip said, we expected new highs by late January, which was on schedule. And I think this week is going to tell us how much further we go. You know, we were sort of penciling in 5,000, mm-hmm. And we could maybe go higher. But from there, yeah, I think an air pocket forms because, one, as you sort of pointed out, investors will get nervous about the Fed and when they start tightening, and parabolic moves, which we've had since October of 2023, usually end in a pretty big retracement. So I do think we continue to be strong, but then after that, I think there's a big air pocket.
So we've talked a lot about the Fed here. Let's talk about...
Okay, before we go further here, do I agree with him or do I disagree with him on a potential downside for the market? Let's just call it in February at some point. And my belief is I 100% agree with him. I do think we're going to have a pullback. I'm not sure it's going to be February or it's going to be March, but I'm pretty confident it's going to be one of those 2 months. And I think there's going to be, regardless, we'll probably head down at some point and have a nice pullback in either February or March is my thinking. And the reason being, and by the way, we could go up further before we get to that pullback, so that's just some food for thought there. But my kind of thinking around that is I think if the Fed doesn't cut rates, or they're not signaling they're going to cut rates in March, a lot of people are going to freak out over that because then they're going to be like, wait a minute, I thought they were cutting. They're not cutting now. When are they going to cut? So that's a dilemma. The second component is even if they do cut, I think it looks bad. I think it looks like, wow, the Fed's really scared of the economy going off the rails here. And usually when the Fed starts cutting, it's not necessarily a good thing for the economy or the stock market. So I think regardless, we're screwed. So I think there's a decent probability we'll have a nice pullback in either February or March. That's just my thinking. But like I said, we could go higher in the meantime before all that. Whoa, okay, that was interesting. All right, guys, so let's keep rolling on here.
So you've got Alphabet and Microsoft tomorrow. On Thursday, you have Amazon and Meta. We've seen these big tech companies really focus on efficiency and where they're spending and where they need to pull back. And it looks like restraining some of the spending where jobs are concerned. What do you expect out of earnings and how might that propel the markets?
Well, this is the biggest week for earnings. I mean, 108 companies report. The FANGs are reporting, both Tuesday and Thursday. And, these companies, I mean, they're big, but they do operate in different spaces. So I think if you have disappointments, let's say you have something disappointing from Apple.
I will be going on live on Twitch on Thursday, by the way, just so you know as well. So it's not just today, it will be Thursday.
I don't think it's going to necessarily weaken the market broadly. It's going to hurt anyone who owns it. But I think for the most part, I think earnings have been delivering. This has been a pretty decent earnings season. And I think it's really confirming earnings this year should be up double digits.
Oh.
What about the jobs report? What are you expecting to come through in that? Because the layoffs, they have been so headline grabbing, but
Yeah.
We've seen such a labor squeeze from smaller businesses. It's not clear that they're eager to do layoffs.
The jobs report is getting harder to predict, right? Because the response rates are lower, and there's been a pretty big divergence between the household survey and ADP and the jobs report. So it is a little bit of a crapshoot to see, but it's still important. And I wouldn't want to see a really bad report. I wouldn't want to see negative jobs, but a softening jobs market would be good.
Tom, it's great to see you on this Monday. Thank you for being here.
Thanks.
All right, that's Tom Lee. Next one up here, job openings increased in December. Confidence hits highest since
Some
December
big
21.
surprises here. Look at that chart of interest rates popping up. Consumer confidence, this is from the Conference Board, January numbers. Headline expected at 114.8, and that's exactly what we had. And that happens to be the best level since Dece of 2021. And if we look at the present situation, it's rocketing from 147.2 to 161.3. Expectations, a little more muted. 83.8, which is the best since July. However, there's an asterisk because last month was revised significantly lower. 85.6 turns into 81.9 to give that 83.8 a comp back to July. Now, job openings, labor turnover for December, always 2 months in arrears, expecting a number right around 8,750,000. A beat here. This breaks a 3-month streak of lower job openings. 9,026,000. 9,026,000. That is the biggest jobs opening number since September. And last month had a revision from 8,790,000 to 8,925,000, which also tends to break that 3 in a row.
Okay, so these numbers are great, and they're also scary. Why are they scary? Okay, I'll explain to you why they're scary. When you get better than feared numbers around this, or better than expected numbers, I should say, not even feared, the dilemma you create there is, why is the Fed going to run out there and cut interest rates right now? Why would they? If we have a situation where the economy is heating up, if anything, and you're still not down to your 2% number for CPI, why would you start cutting? And so that's the way the Fed's going to look at it. So this is where this gets the market freaked out. This gets the market scared because all of a sudden they're like, wait a minute, the Fed might not be cutting rates in 2024. If they do, it might be the second half now. And so all these expectations about the Federal Reserve cutting in the first half are all of a sudden like, we don't think that's going to happen, right? And so that creates this dilemma in the market where, people think stocks aren't worth as much in that sort of environment, right? It's like, it's good and it's bad. It works for the market, it works against the market, right?
Lower streak, but it doesn't matter. This month popped back above 9 million. You see interest rates moving up a bit. A couple of things quickly. Short covering in front of tomorrow's ultimate.
And by the way, I want to be crystal clear. Personally, as somebody that's been in the market 15 years and, studied economics, I would always rather have a situation where the jobs market's better than expected and interest rates are a little higher. I'd always rather have that than a situation where, because when you start losing jobs, like to get those jobs back, it takes sometimes years. And so, that's why I'm like never in a rush about the whole let's cut interest rates and this and that. I'm like, I love a good, strong jobs market. People have jobs, people making money. Overall, it's always a better situation, even if interest rates are much higher than if you had a 10% unemployment rate and interest rates are on the floor, right?
2-day Fed meeting completion seems to be going on, especially in 2 years. If you look at open interest and Germany, negative GDP. And finally, I find this really important. Not many pay a whole lot of attention, S&P Core Logic, but their housing price index year over year, not seasonally adjusted, was the best level since Dece of 22. That's good news. Sarah, back to you.
Yeah, good news all around. But like I said, also the bad news is, people say, okay, Fed's not cutting anytime soon. Next one up here, JB Josh Brown on 6 stocks affecting market momentum this year.
And even the Fed chair himself, it just feels like, with all due respect to Amazon and Apple and even the Fed chair himself, it just feels like the biggest evening of this week for the market, just given what the narrative is and what all of these stocks have done and really what's riding on it. We already feel like we know, Fed's not going to do anything this week. The market's already made up its mind on where things are heading there, but tonight's pivotal.
Yeah, let me be crystal clear before JB goes here. This is everything. This week is everything. because we got the most important stocks all reporting this week, right? Meta, Google, Microsoft, Apple, Amazon. They're all reporting. These are the most important stocks in the entire stock market, other than NVIDIA. And NVIDIA reports still, if I recall, a few weeks from now.
This is it. Tonight and tomorrow night and Thursday, this is it. This is all, I have to tell you, this is all that matters. John Butters at FactSet did something really interesting on Friday that I don't think has gotten enough attention. But he looks at the Mag 7 and notes that 6 of those companies are projected to be the top 6 positive contributors to the year-over-year earnings growth estimate for the entire S&P 500 in this quarter's earnings. So NVIDIA, Amazon, Meta, Alphabet, Microsoft, Apple, these 6 stocks are going to report year-over-year earnings growth of 53.7% for these Q4 numbers. If you pull those companies out, the actual and the estimated results, earnings for the remaining 494 companies in the index are actually negative 10.5%.
Wow.
Mm-hmm. So all of the growth that we're expecting for this quarter, you're either going to hear about it this week or you're not. It ain't coming from anywhere else.
Well, let's be clear too, Jenny, before we take a break. I mean, earnings
Oh, shoot, I forgot. AMD's also reporting after the bell today. So it's AMD, Microsoft, Google, McDougal, and Starbucks all reporting. Oh, Skyworks is also reporting. But yeah, the big dogs are those 4. AMD, Microsoft, Google, Starbucks. It's going to be a fun Twitch live stream today.
Been great. There are stories here and there that have been good. Overall, not great. I thought Ken Griffin's comments to Leslie Pickard down in Miami were interesting about the overall environment. Inflation's moderating at a pace that's frankly better than the market anticipated. We may get Goldilocks, may get a soft landing, may get no landing. Looking at a moment in time where inflation is in the low 2s, the Fed can start to cut rates this summer. We'll see unemployment touch up a little bit, but the overall economy looks pretty damn good right now. That's what Ken Griffin said, and he's managed to, manage their money at Citadel better than almost everybody over these last few years at minimum.
But that brings me back to kind of my beginning of the year thoughts, which is, you're right, earnings haven't been great. And we need earnings to come in this year at plus 12% growth, or we're not going to make it to that $247 estimate.
You better hope that story starts to radiate tonight.
You put it 20 times on that, and you're where you are today pretty much. So I do not see how broadly the S&P moves off from here. And you're right, we better start to hear some good numbers tonight, or kiss the 247 goodbye.
All right.
Is she right about that? Do we need good numbers tonight, or we're pretty much screwed here? And the answer is, I think she's 100% on. Yes, we need to see great numbers tonight. And when I say great numbers, I'm not just talking about meeting expectations. I'm talking about beating expectations. I'm talking about Google coming in and reporting a number tonight that's far better than people anticipate. We know Microsoft always going to come through with their numbers. That's never a question, right? We need AMD to come through with a really good 2024 guidance tonight. We need that stuff to happen. If we get that, this market can keep moving, baby. But we got to have these companies come through. And then obviously Thursday, Amazon's got to come through with some big, huge beats, which I think they will. And then Meta's got to come in with nice beats as well as potentially a very nice 2024 guide. Last video up here, global investors are all in the United States, says Goldman's David Kostin.
Has an S&P target of 5,100. Joins us here at Post 9. David Kostin, welcome to you, sir.
Nice to see you.
Nice to see you. You just got back from traveling the world, right? Europe and Asia. And I'm curious what you're hearing from global investors and what they're excited about.
So, Zara, for the last 30 years, the macro strategy team at Goldman has traveled to Europe and Asia, as you indicated. We were in London, Paris, Zurich, and Frankfurt in the second week of January. We meet with a lot of sovereign wealth funds, investors, institutional investors. And we have an opportunity to exchange views. And then we head off to Asia and we visit clients in Japan, Hong Kong, and Singapore. And so there were sort of a couple of takeaways I thought was interesting this year relative to previous years. First of all, we do a survey, and about half of the portfolio managers are anticipating equity returns on a global basis, somewhere between 0 and 10%, which is pretty consistent with our forecast. We're sort of up 3.5% already this year here in the United States, and maybe another 3.5% or so left to go. Pretty modest upside, as you indicated, Sarah, to maybe 5,100. That's pretty consistent. About half the portfolio managers were in that camp. Another third were in more bullish, and they're somewhere between 10 and 20% type of returns. That's kind of return expectations. They were all in on the United States, and that's unusual because typically there's a home region bias. You go to Asia and there's sort of a bias in favor of the companies there. Sort of understandable. They know them best. But that was not the case. Both in Europe and in Asia, most of the fund managers were inclined towards seeing the U.S. as the best opportunity set. And Japan, Carl, was one that they could have ranked number two kind of across the world that we saw. And kind of way down third, considerably down was China. A lot of concerns around China expressed both in the region in Asia as well as in the European investor community. Yeah. And then Europe was sort of at the tail end. So that's sort of the geographic split. And then within the different
China's
sectors,
going up from here, though,
people were more inclined towards technology. Not a shock there in terms of looking back in performance last year. Number two is healthcare. That was the sort of second most interesting opportunity set. And the last item, Sarah, is your favorite, Magnificent Seven versus the 493. There was a big debate. And it was basically, Carl, kind of 50-50 split, maybe a slight lean towards the Big Seven, but not.
Look at Boeing trying to cling on to 200.
Contrast with our view. My view is that I lean sort of a little bit in the other direction, which is a broadening of the market, the other 493, and sort of given a choice, actually, I'll take the 2000, not the 7, not the 493. We'll take the Russell 2000 in small caps. And that's sort of the lay of the land, having just traveled around the world in 2 weeks.
Has any of the recent action...
Hey, listen. So everybody forgets the Russell Wilson, baby. That baby's still going to roll this year. Tom Lee, 50% plus. Okay, I'm not that bullish, but I'm still very bullish on the Russell as well.
Russell made you question your call for small caps to do better, at least?
Well, the view within Goldman Economics is that the economy is actually growing pretty strongly, very strongly. And as a consequence of that, that actually benefits the more domestic orientation here in the United States of the small cap stocks. They have 30% of their borrowings are floating rate. And so the idea of the Fed cutting over the course of this year will have a one-to-one benefit for a lot of these companies where they have floating rate on the balance sheet, in contrast with some of the larger companies where there is actually pretty stable balance, strong balance sheets, but their debt isn't going to mature until past 2030 in most cases, and there's not that much is floating rate.
And that fits with Goldman 100%. In the March camp.
And that's correct. That's sort of the idea there. And some of the net interest income for a lot of companies with strong cash, strong cash positions should diminish over time as the Fed is cutting kind of 5 times, which is the baseline for the Goldman view. So that's the thought process.
I don't know about that. We'll see. Okay. All right, guys. I'm going live on Twitch right now. You want to join me? Pin comment down there. Much love and have a great day.